Thank you. It's not easy to speak about these buzzing, highly debatable words about fintechs and banks. And my study examines the nexus between fintech evolutions, banks' market power, and risks appetite among Rwandan commercial banks. And this was motivated by a need by contrasting views in existing literature with one supporting the complementary relationship between banks and fintech, while the other one citing a competing relationship between banks and fintech. In Rwanda, we have witnessed fintech banks leveraging on fintech to expand the financial inclusion through mobile payments, internet banking, as well as digital lending. And commercial banks in Rwanda are embracing fintech to improve or to expand their financial delivery, service delivery, and reach the unbanked populations. Also, we are seeing fintechs eating some banks' fees, if I may say, or entering domain traditionally dominated by banks. So this is raising a concern about market power erosions and increasing credit risks. And I would like us to pause a moment and maybe look at this picture and think whether fintech collide or just converge with the banks. So let's ask ourselves like simple questions. Do really fintech eat banks' lunch, or they just help them to serve it better? So I say this is highly debatable, and everyone might bring some views on this topic, but this was the main purpose of our research, was to answer the effect of fintech on the market power of commercial banks in Rwanda, and also looking at the risks appetite. How does fintech adoption influence the risk-taking behavior? We also aim at comparing the bank's behavior in the period of before mobile banking adoption and after mobile banking adoption. Considering that the first banks in Rwanda adopted mobile banking in 2013, so we explored this before and after. We also explored how fintechs are really complementing or just competing with the banks. To look at some numbers, it has been highlighted by those who came before me. Internet banking transactions have just tripled from 2020 up to 2023. We have witnessed the same for mobile banking. Right after the COVID-19, we have seen a surge increase in the mobile banking transactions, as well as the value. Same to mobile payment that have also tripled the value in the period of from 2020 up to 2023. So looking at the global literature, some empirical studies have talked about the fintechs and banks, first saying fintechs reduce banks' profitability by lowering the interest income and increasing the cost of operations. But also Gopal has highlighted that right after the 2008 global financial crisis, fintechs started lending to small, medium enterprises, which was the gaps left by commercial banks. Commercial banks stopped lending to these so-called risky borrowers, and fintech tried to fill the gaps. Competition also from fintechs reduced profitability in the US mortgage market, and I would say fintech are also more vulnerable to shocks due to this increase in technology. It is highly volatile, and they are vulnerable to shocks. But of course, there's no strong evidence whether they reduce banks' market power. So our research, we just used data from 7 commercial banks in Rwanda from the period of 2010 up to 2024, and we compared the period before and after mobile banking adoption, and we used what we call Lerner index to measure the market power, and we used the panel generalized method of moments for our research. Quickly on some of the results, when we performed the cow test to measure the market power, we have seen that comparing the commercial banks' market power before and after mobile banking adoption or just fintech adoption, we have seen that it was insignificant, and this proves that fintechs and banks co-evolve together rather than competing. When we did a panel generalized method of moments on the net interest margin But at the industry level, considering all banks that we've considered in our study, we have also tested the net interest margin, but also considering the bank size, efficiency, and liquidity, and also the fintech dummy we created was positive but not significant. And we said at the industry-wide level, fintech adoption doesn't substantially increase banks' risk appetite. When this was done on bank-specific level, considering the period when a bank started mobile banking, the result was positive. We saw that fintech have a positive effect on the net interest margin of a bank. And we said bank-specific fintech adoption increases their risks appetite. However, this is in diverse magnitude from banks to bank. And this is due to interbank competition, also considering the period, those who came before or those who adopted the mobile banking later. So when we do also a panel GMM on credit risks, we find that market power, bank size, and market share positively influence the non-performing loan of a bank. But also, the fintech dummy created, again, proved to be insignificant. And we said at the industry-wide level, also fintech has no strong link on credit risks. But this change on the individual bank level, where we've seen that fintech adoption increases the credit risks at the individual bank level, and bank offering digital credits via mobile banking may face high NPLs, depending on how they manage fintechs like digital loans, depending on their available liquidity and their strategy. Now, I also want us to still ask ourselves, do they really collide or they just converge? So we've taken 3 evidences in our paper, first one being a convolution evidence and competition evidence. For the one, we say that financial technology companies often ride on banks' infrastructure. So they need banks' customer base, they need banks' compliance and regulation framework, and banks use fintech, as others said before, to develop digital products and reach those unbanked populations. So we haven't seen erosion in market power, which now suggests the complementarity. But when it comes to competition evidence, fintech are bypassing banks by offering some of the services normally provided by banks. This includes payment, lending, and advisory services. Now, due to the change of customer preference, with the rise of technology, customer now is preferring simplicity, speed, and something with fewer intermediaries. So risks now, fintechs are now eating some of the fees or deposit or loans share over time that were nominated by banks. So when we come to collaboration angle, we said banks and fintechs can develop apps, they can develop digital wallets together, and they can do APIs, as some of my colleagues were saying, even open finance coming up. But also the credit can be extended using alternative data with the fintechs. And with the fintechs, also banks can partner with fintechs to digitize customer onboarding and compliance with EKYC. Also, fintech benefit from banks' trust, licensing, and liquidity. So I would say that fintechs provide the trust. Banks provide the trust, and fintech provided the technology. So to conclude, banks are need to reassess and adapt their risks models for fintech-linked products, including digital lending. It's also critical to use alternative data and data analytics to track and manage changes in risk appetite. For the regulators, they need to develop proportional fintech oversight and create standardizations across the ecosystem. But also, we need to strengthen an existing regulatory sandbox for available fintechs. So for fintechs, it's really imperative to align with the financial stability goals, ensure the trust, transparency, and transparency into the credit models and technology that they bring up. There's also a need to strengthen partnership with banks, because we have seen that fintechs often rides on banks' infrastructure. Just concluding, we have said that fintech, the future is not banks versus fintech, but rather banks with fintechs. Thank you very much.